Our guest this week is Mead, founder and CEO of Coolwater Capital. Coolwater is an accelerator for emerging venture capital fund managers aimed at helping them to launch, build, and scale their firms. We talked about what investors should look for in emerging VCs, how they can build durable platforms, and how VCs are using AI to do their jobs better. Winter is one of the most thoughtful LPs in the venture space, so it was great to have him on the show. Please enjoy. Winter, thanks for coming on the show.
Thanks, Joe. Good to be here.
How about we get started with a why, which is why did you start Coolwater?
It's a great question. So taking a step back, there's probably two whys. So the first is when I was investing as a limited partner, you get a really interesting kind of fly on the wall, bird's eye view of what's going on across like the whole market, right? And so I was primarily investing via barbelled strategy when I was an LP, meaning like I was investing into some of the best funds in the world, the largest funds in the world. These are 5, 10, $20 billion private equity firms that have been around for decades. And like they're the most buttoned up, best reporting, best IR, kind of, best performance firms in the world. But I was also doing kind of the smaller funds, like the earlier stage, right? And so as I progressed across about a decade of institutional LP investing, I was going more from like barbell late and early to just early, just VC. And you kind of, you're as an LP, if you're thoughtful about it, you get to look at the market very objectively. And so as I was like kind of looking at the best early stage firms in the world, like I think the one thing they all had in common was like their ability to build exceptional relationships with founders. Right. And so for me, I was thinking about, okay, what do I have that's special? What do I have that's unique? What do I have that's like, right, like a differentiator? Yeah. As if you know me, like I don't like doing things that are redundant, right? I don't just like copy other people. I'm like, oh, that person's doing that. Let me just like copy that. And like people do that in capitalism. But right, like as a pioneer, you're kind of like, what is something that the market doesn't have? That's a harder exercise to do, a much harder exercise to do, to really challenge like the status quo and to kind of challenge like what is there and what isn't there. And so that requires like a certain, cognition of objectivity. And so for me, I was like, okay, how do LPs act? What do VCs do? Right. And who are the best VCs and why? And when you looked at it, like the best VCs, like I said, seem to have the best relationships with founders. And so it felt to me like I needed to create something, right, that would create the best relationships with founders. Right. And, again, VC firms already existed, accelerators already existed, but what didn't exist, right, is an accelerator for funds. Right? Like it's kind of like using a model like innovation. You're kind of taking something that is working over here and you're bringing it over there. Right. And the other place was again, like, if you're going to do something for yourself and like build your own business, like you have to kind of also anchor on like what you're really good at. Right. Or like what your skill set is. Right. And so I was kind of thinking, okay, I also have the skill set of an LP. Right. So how do you combine kind of maybe the innovation that's already happened in the private equity world, the hedge fund world, in the venture world, like with Y Combinator, for example, right? That's innovation. They're a VC firm that has an accelerator operating strategy. Right. And so what they're doing is the same as other VC firms. They're investing into startups, but they have a strategy to do that better than a lot of other seed stage firms. Right. And so as an LP, you're kind of thinking about, okay, well, if I'm going to create something, right, like why am I creating it? What am I creating? Right. An accelerator for funds, but why am I creating it? Which is more around like because like you want to position yourself to have the best relationship with founders. And I think if you do that, right, like you open up what venture is a lot of the time, which is like the right trust levels, the right information channels, the right, kind of relationship to actually get access, right? And so I think that was kind of a really big key kind of point when I was kind of creating Coolwater, was to say like, okay, the what and the how, like that's executing, that's operating strategy, but the why, like why are you doing this kind of the day to day, was super important to be able to like make sure that we positioned ourselves as like the number one value added LP, and we kind of didn't lose that we didn't lose that, right? We didn't lose that kind of ability to kind of interface with managers and be their most helpful partner, right? And I think that also gives us something to be excited about every day. Like we have to earn that moniker of number one value added LP, but it kind of like, I think that was kind of the original why of like, okay, we've got some stuff, I've seen some stuff, right? Like let's take a step back, let's look at it objectively. We can do this, but yeah, like why are we doing this? What does it, enable going forward if we actually like succeed on our operating strategy?
Coolwater gets compared to Y Combinator pretty often, and for good reason. It sounds like there's, you get some examples of how that fits. How would you say the program is different structurally, aside from focusing on managers rather than startups?
Yeah. So I think let me start with what's similar. So sorry, well, not going to answer the question directly. I'll get to it in a second.
No, it's fine.
I think let me start with what's similar and then what's different. For the record, I don't call it the Y Combinator for funds, right? That's the heuristic I think that other people use, because what we do when you say like value added platform, right? Like people don't know what that actually is, right? So they like, I think, just human nature is they want a heuristic. And I think the heuristic is Y Combinator for funds. I think, as I mentioned kind of in the first question, right? Like what we tried to do is create a platform for founders. These are founders of investment firms, right? So what has YC done? They created a platform for founders. I think in the beginning, founders that were often overlooked by other VC firms, right? Or, at that time in the market, right? Like there were just more founders because it was cheaper to start a company, right? And there wasn't like a way to kind of address founders at scale. I'm a partner, I'm on Sand Hill Road. I need to do 1 to 2 deals per year. All of a sudden it's cheaper to start a startup. Now it's like, oh wow, there's like dozens of companies I could be doing per year, but I need to take a board seat. I need to own 20%, right? Like the model had changed, right? The dynamic had changed of like how many founders are in the market, right? When YC started, whenever it was 20 years ago. And so the model has changed for being an LP as well, right? Coolwater has redefined what it means to be a limited partner because there's so many founders of investment firms. And I think that's kind of the parallel where, YC created something because like the market needed it, right? Because VC firms, even if they're great, like they weren't filling that void of like more founder talent in the market and the ability to kind of like engage the founder talent, right? And so we did that, but we did it for founders of investment firms. I think the other similarity is we do most of our training on a cohort basis, right? That makes it systematic, that makes it scalable. And that's important for institutions, but it's also important, I think, for driving value across more of the ecosystem, right? Like how do we make a greater impact? I think the other kind of similarity is we bring in like lots of teachers that have kind of been there, done that, right? So YC, I think the parallel would be you bring in like a great founder has like built a great business, really fast scaling, has kind of like seen it from the firsthand perspective. That's how we think about it as well. Like maybe that's more of a philosophical thing, but it is a practical thing. Like it is like practically, it's like, who do we bring in to teach? Like we are pretty strict about that, where it's like, if you don't know what you're talking about or can't contribute and like help emerging managers, you don't have kind of that bias to kind of help the next generation of managers, it's not the best fit to kind of come in, right? Because it's just not going to resonate the right way with the ecosystem. And so that can be both on like the GP side, like been there, done that on the GP side, like you built something, right? Like you can kind of give feedback that we think is valuable to kind of the emerging managers that are building the firm of tomorrow. But also on the LP side, right? Like if you're an LP, again, you might be active, where, you're writing checks into emerging managers. That doesn't necessarily mean you know how to like train or institutionalize emerging managers, right? It means like you're an active check writer, which is great. But again, like if you haven't kind of sat on the LPAC, contributed to the LPAC, like kind of seen the ups and downs of like, 2 decades of investing into managers, then again, like who are you to kind of give advice and feedback, especially if it's not objective? Like if you're not kind of saying like, hey, this is my perspective, this is the context in which I'm like providing this perspective, then you kind of like lose something, right? Because what you get is just like a bunch of, pundits or whatever that are kind of sitting there kind of talking, but they've never actually like, again, grabbed the reins and have like built something themselves, or they haven't actually kind of invested into enough managers to kind of know like what's what and like how to contextualize it. So I think that's a key point where it's like you want to curate the best. The Coolwater wants to curate the best managers in the world and have them come through our accelerator. But we also want them, right? Like if they're the best, they're going to be very judgmental, and we need to bring in the best to kind of teach them, right? Because they're going to be able to like weed through that very quickly and be like, like this advice isn't good. Like this isn't helpful, right? This person's made 2 emerging manager bets in their life, and like they've both been in the hedge fund world, and now they're bringing it over here and telling me like how I need to build my venture capital firm or private equity firm. And so I think that's like a key point of like just the level of discretion that goes into like running an exceptional program is right. Like you have to like have standards, but also like maintain those standards. And I think that's what Coolwater does in kind of a league of its own. And that's why I think like the best managers love coming to kind of work with us, and the kind of like best aspiring next generation managers kind of love coming to this program, is because of that. Now to answer your actual question, which is like, what is different? We're doing it for funds. We're not doing it for technology companies, right? I think that's the biggest difference. And that generates a lot of additional kind of nuances that are also differences, which I won't go into, but I think that's kind of the biggest thing where the heuristic is there, Y Combinator for funds, but like what actually has been built is very different, right? People are just, I just think like, I can slap a moniker on it and like, it's all done, but it's like the launch of a fund looks very different, right? The, structure of a fund looks very different. The fundraising process is very different, right? Like your organizational development, right? Like is very different. Like there's all these pieces that they're similar in terms of concept, but they are like completely different in terms of like what you're actually building and how you're actually like managing it, right? So the CEO, again, another similarity, like I think YC is very focused on like taking great technical talent and turning them into like CEOs, like managers of their businesses. I think Coolwater, again, similarly is like taking great founder talent, like people that have great track records, but having a great track record doesn't equate into being like a great CEO, building a great team, being a great fund manager, doing fund management, being a great fundraiser, right? Like these are all kind of different skill sets that if you're a great investor, that's what we look for in the beginning. But then like there's all these other things you need to kind of develop as skill sets, right? And there's no MBA out there that kind of does this. Like there's no program out there outside of Coolwater that kind of does this, which is thinking of itself as like, university level training, right? To kind of get you prepared for the world of being like an emerging manager, a fund manager. I think that's really, really important.
On the topic of feedback from LPs to managers, I've got a friend who has a really unique background, very smart, and he's raised a lot of institutional capital for Fund One, which for folks who wouldn't know is pretty rare, impressive. An interesting element to that is that he's trying to manage getting large institutional dollars and the typical frameworks that institutions like to see when they're typically investing in larger, more mature firms, strategies that go with that, with having a different background. And I guess where I'm leading with that, and I'd really like to hear your perspective on, is how do you coach emerging managers on maintaining being authentic and differentiated with scaling and dealing with institutional LPs who sometimes want sizzle, but they like the taste of chicken? And how do they manage that as a manager as they scale?
Yeah. I think it's a good question. How do we train that? I think we kind of break it down into like first principles. So, you're a founder of an investment firm. Like, what are you responsible for, right? Or even before I go there, like, where are you coming from? So, you have to have like this body of work you've done, right? And I think if you're getting institutional capital at Fund One, that typically means like your body of work is very strong. It's like top 1%, right? So again, I think, asked this before, but like, do you know what that is, right? Can you benchmark to top 1% as yourself? And I don't think a lot of managers can. I think some of them just know, right? Where they're like, okay, yes, I like, this is, I'm coming out of a top firm, or like I've sold a company. This is clearly a top exit, right? And they kind of know they're already like top 1%. So their body of work is like very strong. I think that's the traditional body of work, like those two coming out of a like a tier one firm, or having like exited like a very, well-known tech company, or even not well-known tech company, but it becomes well-known because it's exited. Those are kind of the two, I think, archetypes of who gets funded by institutional LPs. And so that's kind of the first piece, which is like, that's the sizzle. Like if you have one of those two, then it's just putting together like the story. So great, like you have the body of work. I think connecting body of work to like the sizzle, like the marketing piece, like the IR piece, like is really important. And I think that, right, that's making it digestible for LPs, in this case, institutional LPs. Second piece there is like, what do institutional LPs look for, right? Like they're not just looking for like a marketing reel. They're looking for actual substance, and like they're checking boxes on kind of the substance, right? So track record is one of those, right? Just like consistency over time, right? The relationship of like what your body of work is to your current fund strategy, especially at fund one, right? Like again, like I've done 20 of these deals in enterprise B2B at the seed. I have a 50x track record. I'm now starting this fund. I'm going to do seed stage investments, B2B in the enterprise. It's like to like, right? So it's like, there's that. And like the LP is going to be looking at kind of your fund product as like a, as a checklist in terms of saying like, okay, here's your body of work, right? Like you can put that story together to have some sizzle, but that's separate from the substance, right? Which is actually them kind of doing the diligence and kind of checking the box and being like, okay, you've hit all these different points, right? That I need to kind of get it through kind of my mandate and my investment committee. So I think that's kind of an important piece. And I think like the last part of your question might have been around like, how does this person kind of take that, I guess, fortunate instance of getting institutional capital and kind of manage that as they scale, like manage that up? I think then comes like the training portion, right? So I've talked with a number of institutional LPs that have backed fund ones, and they're backing the promise, and they're backing the sizzle, and they're backing the body of work. But it's similar, right? Like, what a great team looks like at pre-seed or seed, right? Based on like, this is just investing into like a direct startup. You're like, okay, that team is solving that problem. They've solved it in the past, or like their body of work, like their experience informs like their skill set and their ability to like solve that problem. And you bet on them as like a seed stage investor. But like, just because again, they've gathered capital from, in this case, like direct seed investors, doesn't mean like they're going to be successful, right? It's like they've been able to kind of turn their experience and body of work into a great story, going after a great solution. They've capitalized on that, right? That's kind of like the equivalent of like getting institutional capital at fund one. Like a lot of people say, right? Like if you read all the self-serving kind of Twitter and LinkedIn posts, they're all like, congratulations, I'm so amazing. I closed on like so much money. Now to get to work, right? Which is kind of true. Like that's exactly right. Where it's like, you've done the fundraising piece, you've turned everything into the sizzle, you've gotten the money, but then it's like, now you need to do the fund management piece, the portfolio management piece, the investing piece, right? Going forward. And then you got to layer in fundraising again, right? And then you have another fund, right? And then like maybe you're hiring and like you're scaling up your organization. You're, doing more fundraising with institutional capital. You're scaling your AUM, right? Like all of a sudden it becomes, right? Like you're building something bigger and it becomes more complex. So I think, are you able to, turn your body of work into the sizzle reel that kind of gets you that initial capital? And then can you take that initial capital, right? Which isn't the goal, like at least it shouldn't be. Maybe it is for some people, but it shouldn't be the goal to just like raise the big pool of capital. The goal should be like you're building an institutional firm, right? Which means like great business processes, best practices, you're scaling a real organization, right? Like you're, building an investment process that allows you to kind of like optimize the investment decision-making process, which puts the best assets in your portfolio, which gives your LPs the highest chance of a great return. That's the goal, right? That's kind of what Coolwater is, which is kind of saying like, hey, great, we're looking for the body of work. Come in and we're going to help you ideally launch. But then like, that's not the goal to launch. Like the goal is to build an institutional firm over time. So we position ourselves as like helping build institutional investment firms because of that, because it's not like a point in time. It's not a balance sheet. It's like, we're like the, cash flow income statements of like, hey, you got all this stuff moving on the day to day. Can we help you with that? Right? Can we help you like level up with that over time? And if you do that, right, what we think we're doing is helping increase your chances of success, like helping increase your probability of success for making money at the fund level, which is great for LPs. It's great for you. It's great for your founders, right? It's great for the ecosystem. It's great for venture capital. That's kind of what we view our role as. But yeah, not this point in time. And I think people confuse that. People are like, oh, you help us launch. Well, we've already had a first close. We're set. We're like, okay, well, like if you're actually in venture, you're going to be here for 40 years, right? Like, congratulations, you had a first close, but like there is so much more. And when I hear that, like when emerging manager says like, no, we're all set. We don't like, we got this. We've had a first close. They're either saying like, hey, like we don't want any help, or they're kind of misconceiving the market a little bit of like how hard this is actually going to be. Right. I think for most LPs, that's like a yellow flag. If you're kind of just like, no, sorry, like there's a 0 or 1, like 0 is we haven't raised any capital. 1 is like we raise capital. But like, if you talk to any great IR person at any big fund, right, they're just like, this is the hardest job in the world. I will never say no to anyone. Like I will always talk to a new LP. Like I'll always take all the advice. Like they're like the level of ego is like so low in the best IR people in the world because like they just know how hard it is, right? Like I once talked to a private equity firm where I was like, what's your next 6 months look like? And they're like, well, we need to add like another, I think $3 billion to the fund. And that's going to be like 250 plus qualified purchasers. And yeah, we got our work cut out for us. And I'm like, wow, okay. Like that's next level, right? Like, you have to be like, they're like, yes, we're great. Like we've built one of the best things in the world, but like, there's always that ambition to like build it even more. And I think, it feels like the people I talk to that are really far along, like they've kind of, swallowed their pride in like a huge way. And where they're like, but some emerging managers are just like, first close, like I got this, like I'm the best, like people gave me money. But it's like, what I want to promote and like encourage is to kind of say like, that is awesome, but there's more, right? And just be prepared for that more, right? Like have that mindset where just because you had a first close and you're in business, that's not the goal. The goal is to like return multiples of capital to your LPs and be able to build like an institution if that's what you want to do.
What's a conventional view in venture that you think is BS?
I don't know, give me an example of what's a conventional view you think is BS, and I'll use the parallel.
Solo GPs are riskier than
Yeah.
partnerships, for example. I'm not fishing.
Yeah.
I am a
I
solo
think,
GP, but there's one.
yeah, I hear you. I'm just thinking about the data. I think if you're betting on emerging managers, solo GPs, like emerging managers and smaller funds, solo GPs are a great bet. Most institutions, it felt like probably like 10 years and before, like very rarely would do a solo GP fund, right? Like it was just, it was usually key man risk, right? Key person risk. And so they kind of addressed it as, right, like this key person, key man risk is too much. And I think there's been some reframing largely from like solo GPs, in terms of like, no, we can like, we're more nimble, like we're faster. This is kind of what you're buying in a partnership anyway, is like a bunch of people come together and they're all kind of like independently operating. Right. And then you have like this messaging from the established funds where it's like, yeah, the best deals were usually the most contentious, or like other partners around the investment committee table like didn't agree. Right. And then like you end up saying like, no, but this is like market changing, right? Like it doesn't fit the mold, like it is different. And so I think like to me, bigger firms, like great bigger firms uh, are just a bunch of solo GPs that have like come together. Um, and I think that is kind of maybe missed from like the institutional crowd. And I think when it gets too political, I think the returns start to suffer, right? I think the game becomes more AUM and less like returns focused, where like the intellectual exercise and the operational exercise of generating returns when you're kind of a solo GP, like you're just ideally like the people we want to work with, like you're literally the best in the world at what you do, right? Like that's specialist expertise. You can be a generalist fund and have like specialist expertise, right? But it's specialist expertise in what you do. And like, that's what kind of captures the alpha because you're seeing things, you're seeing the world in a way that like other people aren't seeing it. Right. And I think you have to, if you want to scale AUM over time, it's very hard to do that without being like a bigger team. Right. I think a lot of GPs think they're going to be solo GPs think they're going to be like the next solo GP that raises hundreds of millions of dollars. I think that's like the 1% opportunity. I think the 99% opportunity is like you're going to have to partner with other people. And again, if you kind of view yourself maybe as like you're coming together as this amalgamation of independently operating geniuses or whatever, not to stroke the ego of solo GPs, but like then you have this opportunity to kind of scale up capital. I think that's kind of missed by a lot of folks with like, I'm solo GP, like how come people don't get me? Like I should just be raising hundreds of millions of dollars. It's like, maybe you should, but right, like the institutional world doesn't work that way. Like you typically need to build like an institutional firm in order to like scale up that way. So I don't know if that's like a misconception from the GP point or just something that like, yes, like generally misunderstood by the market, but I don't know. I don't have a
No, it's great.
better
It's
comment for
great.
that.
AI gets a lot of airtime for obvious reasons on the investing side. On the venture firm side, though, have you seen GPs putting AI to work for them?
Um, a little bit. Um, yeah. So we're not talking about the investment portfolios as much as like leveraging the tools that
Mm,
are AI to the benefit of investment firms. We had
mhm.
an AI first fund come through the accelerator this year, right? Like it was basically, let me just take a step back. So if you think about the argument of why GPs even need to exist in the first place, right? Um, they'll say like, well, you know, technology and AI can abstract everything except for like the gut, right? Like the instinct of this is a great deal. And so now I think that premise is even being challenged by like AI first funds, where they're kind of saying like, right, like, no, right? Like if you think about what AI is, right, or what machine learning is, right? It's like, again, taking the body of work, right? You've been so great here. Is it the human decision that makes it great? Or is it like the data that you can kind of like leverage, right? The insight you can leverage from all that data generated in the past to make a better decision, right? And so I think you're kind of seeing it there where, and there's a number of very smart people, including, you know, family offices of tech luminaries that are kind of working on this from like the decision making, right? Like I've got a lot of data, right? That's kind of what, you know, everyone in AI is like, you need proprietary data sets. It's kind of like it's building off of like what you've been good at and it's moving forward where like the GP is the AI. TBD, right? To the point where like VC is still largely, you know, kind of built on access. So it's not necessarily like the uncovering of a great asset, but as much as like getting the access into the great asset, that's like really, really important. So, but I am seeing kind of that application of, you know, turning the GP and the decision making into AI. I think you're more seeing it on like the post sourcing during the due diligence. So more on like the Gen AI, like, okay, great, I've pulled in all these different things. How do I filter my screens like faster? And so you're seeing kind of this obviously proliferation of data, like the world becomes more flat, like, you know, VC is more transparent, there's more data prevalent. What does that mean for investment firms? It means like they have more data than ever, right? And so like do you, right? Investment firms are built on a lot of operating leverage. Like there are very few people for the number of dollars AUM. And now there's very few people based on like, again, the organizational development of a investment firm over time, just like the expectation there and the reality, like there's not many people to actually process all this new data. And so you're seeing it at like okay, great, I've created my channels, right? Like I'm a very well-known firm, right? You're kind of seeing it at like the processing level where it kind of like spits out kind of a package, right? Or an investment memo that is screenable. Like, so all the work that would have been done by, an army of analysts, I think you're kind of like now getting that with like kind of these Gen AI applications of like pulling it all together and like spitting out the ability to like, right, you just go through and you've got your, 100-page deck on Monday that's like sourced from like, your, hundreds of opportunities you saw, and it's like giving you a way to kind of like very quickly like filter that. So I'm seeing that as like an application, like a practical application at the investment firm level. I don't know. Have you seen anything that's kind of different than that?
I mean, I've been putting some of that to work myself for, similar reasons. So initially looking at ideas, helping with DD, creating tools for founders. Like the range of what's available now has just exploded so quickly, and I'm still wrapping my head around what's capable. Um,
Yeah.
just
I
the
mean,
ability to create tools just from text with someone with very little technical expertise. It's just really powerful, and I feel like our imagination's probably behind where the technology is.
yeah, reach out if anyone's listening. Like they've seen like really good, like again, actual applications that have worked, right? They're like not kind of theoretical, but like they're kind of actual firms are kind of using them. That'd be really interesting.
Well, this is a really fun conversation. I'll let you get on with your day. You're probably one of the most networked people in venture, so I don't think it'd be hard for people to find a connection to you. But if folks listening did want to connect with you, what's the best way to do that?
I was saying LinkedIn, right? I get hundreds of kind of requests per month, messages, kind of links to connect. But yeah, do it there, but also like drop me a note, like, hey, I heard it on this pod. I'm curious on XYZ. And yeah, like I run zero inbox. I try to respond to everyone's messages. We'll see how long I can keep that going for. But context is better, because if there's no context, right, then I'm probably going to send like a generic note back that's like, hey, like, what's the context here? What would you like to talk about? So yeah, reach out on LinkedIn. Thanks everyone. Thanks,
Cool.
Joe.
Thanks, Winner.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.